Hey everyone, welcome to Delta Edge. Today, we're diving into avoid these costly stock market mistakes. Stick around till the end because we have an exciting surprise worth 21,000 rupees just for you. You see it all the time, people telling you to invest, promising you'll get rich quick. But what they don't tell you are the mistakes that can absolutely crush your portfolio. Here's the thing, investing isn't about gambling on the next hot stock tip. It's about making smart, calculated decisions. That's what we're talking about today. Common investing pitfalls, real-time examples from NSE, and expert tips to steer clear of costly errors. Let's dive in. Imagine losing thousands, lakhs, even crores of rupees just because of a simple mistake. Sounds terrifying, right? It happens every single day in the stock market. Today, I'm going to show you how to avoid those costly errors and protect your hard-earned money. But first, a quick teaser. How would you like to automate your trades and make your money work for you, even while you sleep? Stay tuned to find out more. Alright, let's talk about the first mistake. Chasing the hype. You know how it goes. You see a stock skyrocketing, everyone's talking about it. Your neighbor's uncle's dog walker is suddenly a stock market expert. It's tempting to jump on that bandwagon, right? Well, let's look at StockX, currently trading at 500 rupees. Now, look at this chart. See that massive spike? That, my friends, was a hype-driven rally. People saw the price going up and thought, I don't want to miss out. They piled in, driving the price even higher. But then what happened? Reality set in. The fundamentals didn't support that price, and it came crashing down. Many investors who bought in at the peak, fueled by fear of missing out, are now facing serious losses. They chase the hype instead of listening to their heads. And that's the danger. Emotions can cloud your judgment and lead to impulsive decisions. Remember, the stock market isn't a casino. It's not about gambling. It's about investing in companies with solid fundamentals, businesses that are built to last. Don't get me wrong, there's nothing wrong with being excited about a company or an industry. But before you hit that buy button, take a step back. Ask yourself, is this hype-driven or is there real substance behind this rally? Look beyond the headlines, do your own research, and avoid following the crowd blindly. Trust me, it's better to miss out on a few quick gains than to lose your shirt chasing a stock that's all hype and no substance. Remember, slow and steady wins the race, especially in the stock market. Let's move on to the next costly mistake. Ignoring fundamentals. It's like judging a book by its cover. You might be drawn to a fancy title or a flashy design. But what really matters is the story inside, right? Same goes for stocks. A company's stock price is just the cover. The real story, the fundamentals, are hidden within the company's financial statements. And trust me, you need to read those financials. Let's take stock Y as an example. Currently, trading at 150 rupees, it might seem like a steal. But take a look at the company's financials. What do you see? Declining revenue year after year. High levels of debt that seem impossible to pay off. These are major red flags, warning signs that something isn't right. Yet so many investors ignore these glaring warnings. They see a low stock price and think it's a bargain, without bothering to understand the company's financial health. This is like buying a used car just because it has a fresh coat of paint without even looking under the hood. Before you invest a single rupee in any stock, do your due diligence. Dig into the company's financials, understand their revenue streams, their expenses, their debt levels. Look for consistent profitability, strong cash flow, and a healthy balance sheet. Don't be afraid to get your hands dirty with financial statements. There are tons of resources available online to help you understand them. Or, if you're not comfortable with the numbers, consider consulting with a financial advisor. Remember, investing in a company without understanding its fundamentals is like playing blindfolded darts. You might get lucky once in a while, but in the long run, you're bound to get hurt. Alright, let's talk about a mistake that's all too easy to make, especially in the age of instant gratification and online trading. Overtrading. You see, the stock market isn't a casino. It's not about quick wins and instant riches. But many investors, especially beginners, get caught up in the excitement of buying and selling, trying to time the market perfectly. They see a small gain and think, let's cash out, or a small dip and panic, hitting that sell button. This constant buying and selling, driven by emotion rather than logic, is what we call overtrading. And it's a recipe for disaster. First of all, every time you trade, you incur transaction costs, brokerage fees, and taxes. These costs might seem small individually, but they add up quickly, eating into your profits. More importantly, overtrading often leads to impulsive decisions, driven by fear and greed, rather than a well-thought-out strategy. You end up buying high and selling low, the exact opposite of what you should be doing. Let's look at this chart of a volatile stock. See all those ups and downs? Imagine trying to time the market perfectly, buying at the dips and selling at the peaks. It's nearly impossible, even for seasoned professionals. Instead of trying to be a stock market wizard, focus on being a patient investor. Develop a solid investment strategy based on your financial goals, risk tolerance, and time horizon. Stick to your plan. Avoid making emotional decisions based on short-term market fluctuations. And remember, time in the market is more important than timing the market. Let your investments grow over the long term, and you'll be amazed by the power of compounding. Don't put all your eggs in one basket. In investing, this is the golden rule. Failing to diversify can wipe out your savings. Spread investments across different assets. Stock Z was a market darling, then it plummeted by 30%. This is the danger of putting all your eggs in one basket. Diversification helps mitigate risk. Explore bonds, real estate, gold, and cryptocurrencies. Diversify within each asset class. Diversification is your best defense. Let's talk about a mistake that many investors, especially beginners, tend to overlook. Ignoring technical analysis. Now, I know what you might be thinking. Technical analysis? Sounds complicated, but trust me, it's not as intimidating as it sounds. Technical analysis is simply the study of past market data, primarily price and volume, to identify patterns and trends that can help predict future price movements. It's like looking for clues in the stock's price history to understand its future direction. Now, I'm not saying that technical analysis is foolproof. No investment strategy is. But ignoring it completely is like flying blind in the stock market. You're missing out on valuable insights that can help you make more informed trading decisions. For instance, let's look at stock A. Before its recent drop, the stock was showing clear bearish signals, warning signs that the price was likely to decline. These signals, like a death cross or a head and shoulders pattern, are visible on the chart if you know where to look. Investors who understand technical analysis could have spotted these warning signs and potentially avoided significant losses. They could have sold their positions or even profited from the decline by short-selling the stock. Now, I'm not going to turn this into a technical analysis crash course, but I urge you to explore this powerful tool. There are tons of resources available online, books, courses, even YouTube videos that can teach you the basics of technical analysis. Remember, knowledge is power, especially in the stock market. By understanding technical analysis, you're equipping yourself with an extra layer of insight, helping you navigate the market with more confidence and potentially avoid costly mistakes. Now for the special surprise I promised. We're giving away 21,000 rupees worth of 5 financial calculators to one lucky viewer. All you have to do is subscribe to our channel, watch till the end, and send a screenshot to our WhatsApp number 911-32-11787. We'll announce the winner in our next video, so make sure you have those notifications turned on. And hey, while you're at it, don't miss our exclusive course on how to automate trades, normally priced at 7,000 rupees. But for a limited time, it's available for just 99 rupees. That's less than the price of a pizza for the knowledge and tools you need to make your money work for you, even while you sleep. Click the link in the description to grab your spot. This offer won't last long. So there you have it, folks. Avoid these costly stock market mistakes and set yourself up for success. If you found this video helpful, smash that like button, subscribe, and share it with your friends. Remember, your financial journey starts here at Delta Edge. Your Gibanin and Tatas.